All righty, we are back in the saddle again, ladies and gentlemen, boys and girls, moms and dads of all color, creed, race, religion. We are back at your Insurance Corner, coming to you live from the studios in Round Lake Heights, Illinois. My name is Bill Miksch. I'm president of W.D. May Financial Group in Grays Lake, Illinois, and we are about to go on an excursion of, yes, dare I say, life insurance. Oh, the dreaded life insurance. But I'm going to show you guys over the next couple weeks how this kind of life insurance actually can outperform. I'm going to ruffle some feathers. I can show you how it will outperform, everything being equal, a 401k. God's truth. There are some commitments involved, but stay tuned. It won't be today. I'm gathering my data. I've already seen some of the numbers, and I'm excited. I'm wetting my pants about being able to show you what this looks like compared to a 401k. Wetting my pants. And with that, nice entree to a segue to the man, the legend, the way of life, coming to you live somewhere from the bunkers in Columbus, Ohio. Sean Hauser.
Hello, Bill. How you doing tonight?
Oh, I'm just finer than a frog's hair on a turtle's belly, Sean.
Okay. Well, I am not wetting my pants, so one of us here is not incontinent. Yeah.
Well, it won't be this week. I'm gathering my data. I just saw the preliminary stuff before I left the office, and I was actually blown away by how much money was in this thing after a 25-year pay-in. So I'm just telling you, it's amazing. It's amazing, but it's not for everybody. I'm the first one to tell you, you got to go in with your eyes wide open. This is not something you can start and stop like a car. So anyway, I'll leave that for another week or two. I'm not sure, Sean, if I'm going to be in town next week or not. I've got a large group in Florida that's going through a renewal, and it's kind of ugly and a few moving parts. So I'm likely going to be down there next Tuesday. So folks, stay tuned. Sean, stay tuned, and we'll see how that goes. So, how was your vacation, young man?
Everything was great.
Everything was great. Was it a staycation, or did you go somewhere?
No, I was actually in the 49th state, if you know your geography.
Washington?
Starts with A and ends in Alaska.
Oh, Alaska. You were in Alaska. Oh, very nice.
I was. I figured they couldn't find me up there, so that's where that's where I'd go on vacation.
Did you? Was it a cruise that you and Kelly went on, or something else?
Part of it was, yeah. Part of it was.
You and I are going to have to chat because I have a significant birthday coming up in about a year.
Okay.
I'm turning 28 again for the 27th time. I don't know, 37th?
Okay.
37th time.
Oh.
Yes. So I want to do an Alaskan cruise with Sally and possibly my best friend and his wife. When my best friend Glenn turned 65, he wanted to go to Vegas. So Sally didn't come on that trip, but I went to go see him.
Okay, cool.
And so I want to pick your brain about how you what you did, who you chose, where you went, what to do, what not to do. Et cetera, et cetera. So, are you still there?
I'd be happy to tell you who to pick and where to go.
That's somebody is messing with the screen.
Oh.
We have a ghost. We have a ghost on the monitor. All of a sudden, I see the arrow moving, and my hands are sitting on the table. So, somebody from the engineering department must be. Maybe you were too loud. I don't know. I had you turned up all the way, so maybe that was what was going on. I don't know. By the way, I was chuckling. Remember a couple weeks ago when we started Tin Man?
Yeah.
There's a bar here that kind of makes the thing go faster or slower.
Yeah, the pitch. Mm-hmm.
Yeah, and somebody turned it all the way to the bottom, and this time I knew how to fix it. All I could do was laugh.
Yeah.
I'm like, okay, somebody either set me up or they were doing something in here that I didn't know about.
I gotcha.
So, anyway, just a couple of little tidbits. Yours truly, also known as Engaging Time, had my first paid gig this past Sunday, Sean.
Okay.
And I have another follow-up one, August 11th, at the same venue. I've been invited back. Full disclosure, I didn't think I did all that great, but because virtually nobody was there, it was a practice session. That's how I took it, and I got to take some learning lessons from that and get a better stage presence and be a little bit more over the top, let's say.
Sure.
So
gotta be the stage. They gotta be the stage. Gotta work the stage and have that presence. And
I'm being told that there are going to be people coming to see me this time, so I got to be a little bit better. Yeah, but I will say this: "Don't Burn the Bridge" was my last song of the session before the rain came. That's what kind of bailed me out, to be honest with you. The rain came, and I'm like, thank God, there's a God. Thank you for getting me out of here. And so 4 or 5 people showed up at the Tiki Bar. Just before it started raining, and I started going into Don't Burn the Bridge, and everybody, almost on cue, saw their head bouncing, their knee bouncing, and I'm like, and then I went into, there's a line in there that you go, are you ready, are you ready? And I was looking right at them, and they all turned to me in unison, and like, yeah! And I'm like, okay!
Good deal.
That's what I want to hear. So I ended with a good note, but there were some moments where I just assume bury that part and fix it. There was a couple songs that I had in my set that I chickened out how to playing them. One of them was "Have You Heard the Rain" by John Fogerty.
That's a good one.
Great song. I had a complete brain meltdown, Sean. I couldn't remember how it went.
Oh.
So I had the chords in front of me. Doesn't matter if I don't know the repartee of how that song is supposed to go. It ain't gonna sound the way it's supposed to. And my first song was Wagon Wheel, and just to get a picture of this, so I'm in the bottom area where the Tiki Bar is, and there's a restaurant above. I don't see any, but they can hear me, but I can't see them, and they can't see me. And so I finished Wagon Wheel, and it was okay. It wasn't great, but I got an applause from upstairs. I'm like, okay, that's, base hit. So
It was either, yeah, that was great, or yeah, he's over. But, you didn't see him, so.
I couldn't play to them, but you know what? This was good to get that part of it out of the way, because I told my guitar teacher, I told my voice teacher, I'm not ready, I'm nervous. Nobody's coming with me. I'm a duck out of water, and they're like, "You're fine, and I'm like, "No, I'm not," and I really wasn't. But I made it through, and I want to shout out to my son Trevor. Trevor was my roadie, and thank God, he helped me pack the car to get there, unpack the car, load it up. I got everything plugged in, and when the rain came, he was Johnny on the spot to get my guitars out of the weather very quickly, because otherwise my guitars would have exploded.
Well, that's great.
Metaphorically speaking, they would have been broken badly. So, yep. So, and then this weekend, we're doing a tour of Wrigley Field, an official tour. We have to be there at 8 o'clock in the morning, 7:30 technically. And the tour starts at 8. And we're going through the history of it. We're going through all the tunnels, the locker room. We're going to be able to meet a couple of the Cubs. And then they got a special luncheon for us. So this is a legit VIP tour.
Wow, nice.
Yeah, and then the following week, we're going to White Sox Park, and that's an evening game, and then we're staying the night because I don't want to drive back. But on Sunday, because Sunday's the 11th, and that's when I play, I already told my beautiful bride we're going to have to get up early because I got a show. so,
yeah, it's the life of a road stage act.
Oh yeah. So, but engaging time next August 11th, 2 to 5 at Fairmont Shores. So if you are in the neighborhood, folks, come on, bring your tomatoes and bring your laughter and be patient with yours truly, as I'm still learning how to do all of this. So we're going to get on with life insurance, Sean.
Okay.
So last week, while you were cruising the Alaskan shores and doing your excursions, which I'm envious beyond belief, I will tell you, we spent most of the show talking about term insurance, and I just want to do a quick recap before we get into the permanent stuff. So term is nothing more than renting a policy. There's no innate value, there's no intrinsic value, there's no cash value. You are basically renting that policy. You pay a premium, you have a death benefit. If you die, the life insurance company will pay your beneficiaries. If you don't, they won the bet, they keep the money. The only exception to that, which is very rare, in my humble opinion, is there is a provision in some term policies, in some insurance companies, will allow what's called a return of premium. So let's say you buy a 20 or a 30-year term policy, which means the premium is set for 20 or 30 years, cannot change. You last the policy, you get to the end, and the insurance company sends you the money back. So it's a return of premium. The upside is it's a return of premium. The downside is this. For the amount of money you just spent for that life insurance policy, for probably the same amount of money, you could have had a permanent policy after 20 or 30 years and then said, I don't want to make any more premium payments, let the policy live on its own. So while that provision in there is a return of premium, I've never had a single client ever buy one, and the moment I show them a premium which shows return of premium and one that's permanent, the return of premium goes into the toilet, and they're like that. Then they either decide to do the permanent or they don't do it at all. So term insurance, there is increasing annual term. There's 5-year term, 10-year term, 15, 20-year, 25-year, 30-year. Every now and then, if you're young enough, a 40-year, and then there's this thing called term to 100 or term to 95. Those policies are typically universal life policies priced in such a way that it's really permanent, but there's really not cash value going on. There could be, but from a practical matter, it was priced so it would last until you're 95 years old or 90 or 100, whatever parameters you put in when you design the policy. So, and then the last thing about term insurance is there's this thing called a waiver of premium, and there are some brokers that don't like it. I'm a big fan of it, in part because if you ever became sick or disabled and you could not work anymore, and I've got family members who are in this very space, if you become sick or disabled and you can't work, the policy will have a provision in it, if you got it approved, that will pay the premium until you're 60 or 65 years old. No questions asked, if they approve the disability. And that way, you're no longer having to pay for something. The insurance company, because of that provision in the contract, is paying for that policy. So you have a policy in force until it gets to the end of its term, or until such time as you can start paying for it again. So those are basically the elements of a term insurance policy. They're meant for short-term things or for very succinct things. I haven't talked about the business element of life insurance yet. That's going to be for a different show or probably multiple shows. But this is on the personal side. So people will buy term insurance to protect their house. I hear this thing called mortgage insurance. folks, that's life insurance. It's not. It's a fancy term that mortgage brokers like to use to get you to buy their insurance at an expensive rate. And a lot of times, if you don't see what's going on, the policy will be decreasing term as the mortgage goes down. So does the policy. But what if you refinance? Now that policy was set maybe at $500,000. Now it's down to $350,000, and then you refinance and you're back up to $400,000. That term insurance policy now doesn't do you any good, or if it does, it's not settling the whole debt. And in some cases, the mortgage insurance has the beneficiaries being the bank, not the family. And I am not a fan of that, not at all. Let the family decide how they want to deal with the remains of the house and so forth, rather than giving the money over to the bank, and now you still have to deal with property taxes and the maintenance of the house, and maybe you still have to sell because it wasn't enough money. So that's term insurance in a nutshell. So let's get on to permanent. Permanent coverage is exactly what it is, and there's basically 5 types of permanent coverage. There is whole life. Most people have heard of whole life. I'm going to get into the dynamics of each one of these in a minute. There is also something called blended whole life, where you blend inside of a whole life policy. It's partially term, partially whole life, but it's whole life in its purest form. And as the dividends accrue inside of that policy, the term portion of the policy gets broken down. Yeah, they buy more pieces or units of life insurance, and eventually the term goes away, and it becomes all whole life. The cash value in those blended ones are not as good as a pure whole life policy, because you're paying, you're having the dividends pay for term insurance to buy the term out, rather than going into the cash value. But if it gets you more insurance in deference to the cash value, as an insurance professional, I would say that's a better deal, because I've said this before. I said this last week too, Sean. And I've delivered a death benefit 4 times in my career. Nobody ever asks what kind of policy was it. They never ask what cash value was in it. They never ask about what kind it was. They ask, how much am I going to get, and when am I going to get it? That's what they're going to ask. That's what they ask. They don't care what it was. The only person who really cared was the buyer of that policy. So whole life is a very simple product in its function. The premiums are set for life. So if you buy one at age 10 and it's $100 a month or $50 a month, it's $50 a month when you're 80. It's $50 a month when you're 90 if you continue to pay for it. If it's blended, it's still $50, but it might take you a while for that policy to fully come together. Then you have universal life. Now, Sean, when did you go to college?
Graduated in 92.
Okay, so you're familiar with E.F. Hutton, right?
Oh, when they talk, I listen.
Yeah. Yeah. The last I heard, they're not in business anymore. Am I right about that? Not.
That is correct.
Yeah. So E.F. Hutton was one of the brainchildren for Universal Life back in the 80s. And so what Universal Life is, it's based on a annual increasing term insurance policy. So every year the cost of insurance is going up, like it would in a normal policy, and then the actuaries figure out how to flatten things out. But in a universal life, it's an annual increasing term cost. So inside the mechanics of the insurance, it's going up every year as you get older. And then you have an interest crediting feature. Interest, not dividends. Dividends are a return of profit from a company who is making dividends, and there's basically 4 companies in this space from a practical matter that are worth their salt. I'm not going to say who they are because I don't want to run a commercial. But dividends are a return of profit from the carrier. Interest is basically, it's kind of like, the way I explain it, It's a CD. You've got a CD kind of a bucket in terms of your crediting feature or your interest crediting feature, and it's a term policy. So when you buy a universal life policy, you've got some flexibility as to the premium. It can be $50 a month, $25 a month, $100 a month, or whatever you want, all the way up. There's no limit per se. Well, there's a limit, but I'm not going to get into how that works at this point. And a universal life policy, if it's structured correctly, it's either going to last forever, or if it's underfunded, which means the quote was based on, let's say, $25 a month for a $250,000 policy, and you saw the illustration. Now, I'll put this in perspective, Sean. In the late 80s, what were interest rates?
Late 80s? Geez, no. They were higher, though. I would say
8-9% maybe.
Something like that. Yeah.
Yep.
I mean, I remember my first mortgage 6 years after that was in the 8s. So.
Yep. So
70s they were wacky. So.
Yeah, but they were in the 14-15%. I mean, when you were illustrating life insurance policies, when interest rates were at 15%, it would be like a symphony singing off the paper. Look at the cash value; it's growing like leaps and bounds. It's never going to stop. What the insurance carriers, and I can speak to this specifically because I sold for one of the big ones when I got into this business, they didn't tell us how they worked. They just said, show the illustration. That's what's going to get their attention. They're going to buy all day long. That's basically the essence of what we were told. They never told us how it worked. And so back then, interest rates were 7, 8, 9, 10, 11, 12%, and you can legitimately run an illustration with those interest rates because that's what they were back then. And the cash value would sing. Sean, what happened after 9/11 with interest rates?
They dropped.
Mm-hmm. For how low did they drop? Do you remember? Do you recall?
Right after or like over time?
Over time.
I mean, it really... Well, it started really the fall of 2001 till...
Just recently, right?
Yeah. Yeah.
So we basically were in the single digits, low single digits, for almost a decade and a half, maybe almost 2, right? Interest rates were dropped down to 2%. I mean, people would go and get a CD and they were getting an annual rate of return of 1.5%, 2%, and they're like, "Yay, rah, I'm rich."
Mm-hmm.
That's what would happen to these universal life policies. So think about this: you're putting $50 a month away in the 90s, and this thing is starting to sing. But now you're 15 years older, 20 years older. You're still doing $50 a month, but now the interest crediting is not getting 7 or 8%. It's only getting 4%, because that may have been the minimum that the insurance company guaranteed. Meanwhile, the cost of insurance is now 20 years older. There is a point at which the premium and the cash value are going to meet. And when they meet, at some point, that policy, that universal life policy, the insurance company is either going to start taking money out of the cash value to support the policy, or they're going to call the policy and say, "Hey, Sean, I know you've been paying $100 for the last 20 years, but it's underfunded. It's going to go underwater. It's going to collapse. We need $200 starting next month." If anybody made a phone call to you like that, what would your response be? 20 years later, remember.
20 years later.
You're not going to be happy, are you?
No.
Nope. A lot of people let their policies lapse, not because they wanted to. They didn't even pay attention. They just thought they were on automatic pilot. And what makes this more confounding to me, Sean, from a professional standpoint, and we're kind of in that space right now with everything going electronic, your paycheck. Everybody wants to be ACH the minimums so that you're at least you're paying the minimums on your credit card and you don't go into default and have a credit whack on your history, on your credit history. Well, the same thing is true in the life insurance world. If you only get an annual statement, but nobody's there to talk to you about it, because the agent's no longer there, or they retired, or whatever, and likelihood he's no longer there, then who do you talk to? You call a 1-800, big behemoth insurance company? Good luck with getting somebody on the phone, first of all, now. And then second, if you do, good luck trying to find somebody who actually understands how the policy works. And so people just let it ride, and they would look at the statement and go, oh, look, I got money, and it went up. They would leave it alone. They wouldn't understand what's going on. And then at 20 years later, that phone call comes in and says, Mr. Hauser, I'm sorry, but your premiums are going to go up $100, otherwise it's going to collapse. And you're like, wait a minute. I was healthy back then, but now I got moving parts. I'm not even sure I can get the same policy anymore. It's certainly not at the rate that I'm paying. Well, we'll keep it together, sir, as long as you pay another $100 a month. Well, that's not what I bought. Well, that's how it works. Didn't they tell you? No. No, it didn't. So Universal Life during the basically right after 9/11 and ostensibly for the next 10 to 15, 18 years, just up until recently, interest rates were at rock bottom. And the cost of those insurance policies were still going up. So a lot of Universal Life policies either expired or just went away, and people just said, the heck with it. They didn't know how to deal with it. Honestly, Sean, if they did understand them, to me, I'm going to say this out loud maybe, there might be a legal action that could be taken because they weren't that nobody explained how these actually work. And to some degree, the agents weren't even told how they work. So while Universal Life does have a play, and by the way, now, fast forward to now, where are interest rates? 6, 7, 8%?
Yeah. Now there's a lot of talk about will they go down, but yeah, this is actually normal interest rate territory.
Totally agree with you. But now these Universal Life policies might get legs again because the interest rates are higher. And I'm just saying, buyer beware. Understand what you're buying, and make sure that death benefit and that premium is going to be sound at the minimum interest rate down the road. Not just today, but 20, 25, 30 years from now, because you don't want to wake up at 85 years old and find out your policy has lapsed because it ran out of money. And now you're screwed. You can't get it. So that's Universal Life. Indexed Universal Life is the third type of Universal Life. Same kind of chassis, except now the interest crediting features, Sean, are indexes like the S&P 500, and there's a bazillion other indexes, some that are known, some that you have to kind of look up and look under the sheets to go, what the heck index is this one? But they're based on the index. Now, when you're in an index, you're actually not in the index. You're mirror imaging the S&P 500. So you're not actually in the S&P. The insurance company might be, but you're not. And they're going to say, okay, the S&P was $2,500 today, and what is it a year from now? If it's at $2,600, you made some money. In an indexed Universal Life policy, if it went from $2,500 and at the anniversary of your contract, it dropped to $2,000 because the market had a meltdown, you didn't lose a penny in terms of your cash value. Your death benefit didn't change. Your cash value didn't change. You didn't lose any money. So the upside of an indexed Universal Life policy is that you get a more, I don't want to say predictable, but you get, in my opinion, a safer product because the indexes are going to perform more than they're not over time. And when they don't perform, you don't lose anything, as opposed to a Universal Life policy. When the interest rates collapse, so does your policy. The interests you're not accruing the same amount of money, and the accrual of the money, the cash value inside a Universal Life policy may not be held up to substance down the road. In an indexed Universal Life policy, that doesn't happen. However, the same flexibility exists with an IUL, as we call it, or a Universal Life policy. The key is to make sure you put enough money in there so that you look back 30, 40 years from now, and maybe you got some decent cash value, but the policy's not going to collapse on you. In fact, my attitude is you want to run these policies, whether you're doing universal life or index universal life, in such a way that you get to 65, 70, 75, and you then say, Sean, I don't want to pay for this anymore. Is there enough cash value in this thing to support itself? Because
and when you say support itself, is that where the income thrown off by the investments that are underpinning, or the index that's underpinning that, is enough to pay the premium?
Yes, exactly right.
Okay.
Because in a whole life policy, your dividends are going up every year, guaranteed. I don't know what they're going to go up, but they're always going to go up. You're never going to see a decrease ever in a whole life policy. It's always going to go up. At some point, the dividends are going to overtake the cost of the policy, meaning the premium. And at that point, you can say, Mr. Insurance Company, the dividends are at $4,000 or more, and I'm putting in $2,000 a year. Let the dividends pay for my policy. It won't grow as fast now, but it will not expire. It will be fine. In an indexed crediting environment where you're banking on interest rates, whether it's in an index or like a CD bucket kind of thing, you're hoping that you pick the right index, or you're in an interest rate environment like we are today, where 8% is probably going to sustain that policy in the out years. But you want to make sure the premium is set when you buy the policy, so that when you turn 80 or 90, it's not going to expire on you. And I think a lot of agents get caught up in, I don't want to lose a sale, and I'll acquiesce to the client. I wanted them to do $300 a month, and they're only willing to do $150. And you should know intuitively that ain't going to work long term. You better be paying attention to this, and you chicken out because you want the sale. I understand that. I get the dynamics of that, especially if you're new. But agents have to really understand what they're selling, and because God knows the buyer doesn't. God's honest truth. They don't have any idea what they're looking at. They just see numbers, and they see the numbers going up, and they get all excited. Now, the intuitive buyer, somebody like yourself, Sean, you're going to understand it. And that's what brings me to the next one, is variable. You know what? We're past our time. I got to take a break. So, any questions, Sean, before I move on with this?
No.
All right.
Ready for variables when we get back.
Absolutely. This is WLCB Lakes. I can't talk. This is 101. Okay. Let's try that again, Sean.
This is WLCB 101.5 FM in Slate's Corner, Wisconsin. That's Bill Mitch. I'm Sean Hauser. And we'll be right back after these messages.